Rock solid dividends. How would you go about putting together a portfolio that would guarantee decent income in retirement? So, when I see things like this, looking at the fear and greed index, I sometimes think maybe a growth orientated equities portfolio isn't the best thing to have in retirement, and that it's worthwhile also looking at an income portfolio that has rock solid dividends that I can rely on, where I don't need to do anything at all in retirement and just collect the cash. So, the Association of Investment Companies have compiled a list of dividend heroes that have maintained or increased their dividend for 20 years or more. And with these in your portfolio, there's no need to sell when the going gets tough, as hopefully the investment trust will still achieve its objective in terms of delivering income for you. For an income portfolio, you could use investment trusts, exchange traded funds, or open ended investment companies. But with investment trusts, they can hold back dividends they receive from the companies they invest in and create reserves. And then from these reserves, they can pay out dividends in the future if there's something like a recession and the companies they've invested in have cut their dividends. The investment trust doesn't have to. So, exchange traded funds and open ended investment companies will have variable dividends and dividend yields depending on what's going on in the economy, whereas an investment trust can maintain and even slightly grow income over time. So, it's a very suitable investment vehicle for retirement. Here's an example of some of the information that the AIC website provides. So we've got things like the dividend yield, dividend growth over the last 5 years. We've got the revenue reserves that it can use to potentially pay out income from, and then the dividend cover, which is the reserves over the annual dividend that it pays. So for Merchants Trust, if it received no income from the FTSE 100 companies it invests in, it would have 0.56 years worth of investment cover. And we've got the dividend record here, what's gone on each year. So it's quite a good website to just have a look and compare different investment trusts. Here is an income portfolio from Interactive Investor, and it's got a mixture of investment trusts like City of London, and it's got some open-ended investment companies in there as well. The problem with the fund is the model portfolio is that the historic yield, it states it's 4.11% as an average, but actually when you multiply things through, it comes out at 3.6%. So it's not really high enough, I think, to live off. I would look for at least 4% in an income portfolio. Also, it does do things like it's got property in there at 5%, but that's not really enough if you think property is a true diversifier. Then also it's got a mixture of bonds in there, which is kind of okay. And then some of the equity income funds like the Fidelity Global Dividend and the M&G Global Dividend don't actually have strong enough yields. So I probably change those for some higher yielding investment trust potentially. And then that would help to really get a more solid income portfolio. Here is an income portfolio from John Barron, and he writes in the Investors Chronicle. I'll let you pause the video and you can look through all the different holdings and their weightings. But my conclusion is that there's really quite a lot of funds here, quite a lot of investment trusts, and you don't really need that many in your portfolio, unless maybe it's in the millions and then it might be worthwhile. So, although there's some good ideas in here, I would be looking to select the best few and go forward with those. Here we've got the investment trust dividend heroes from the AIC. So we've got the sectors here. It's quite interesting that they're all equity apart from this one that's property. We've got the number of years it's increased or held the dividend. We've got what the dividend yield is, and some of them have very low dividend yields going as low as 0.5% for Scottish Mortgage, some under 2%. We've also got the annualized dividend growth rate here as well. So we can look at the ones that have a yield of over 4%, and they're possibly the best ones for our rock solid dividends in terms of just living off the dividend income and not needing to sell down any of the capital. So some of the favourite ones are City of London, Merchants Trust as well, JP Morgan Claverhouse is another very favourite one. Mainly UK equity income that we've got here in terms of having 20 years or more of dividend growth. So here we've got the next generation of dividend heroes where they've got between 10 and 19 years of dividend growth. Again, mostly equities. We've got TR Property, that's property securities, so it's like a fund of funds investing in property. We've also got International Public Partnerships, INPP, that's an infrastructure fund and one of the largest infrastructure funds. And arguably, if you were to hold infrastructure in a rock solid income portfolio, then that's a potential choice for you. Other than that, we've got lots of equity here. Murray International Trust is quite a favourite amongst a lot of investors. And then again, we see quite a lot of UK equity income. So although it's useful to use these investment trusts, we might have a bit of trouble diversifying away from UK if we solely rely on them. One of the dividend heroes has been Henderson Far East, and its yield is currently in the high single digits. But the problem has been that the share price performance has been absolutely atrocious, pretty much a continual decline over the last 5 years. And it's had a much worse price performance than an equivalent exchange traded fund. Here we've looked at the Asia Pacific Dividend ETF. So is Henderson Far East boxing itself into a corner, trying to maintain its dividend and investing in the wrong companies in the process? Or is it due a lucky bounce? I think that if you chase high yields, you'll generally end up being disappointed. When we look at some stats for the ETF, we see 50 holdings, so not too diversified. We see an ongoing charges fee of 0.59%, which is pretty high. We see a sector breakdown where financials, number 2, 20%. It's not too bad. The geographic breakdown, it does avoid China, but you've got Hong Kong in there, and you've got quite a few countries that sell a lot of product into China. For the dividend yields, they varied from a low of 3.1% up to nearly 7%. And what's really interesting is that the current price to earnings ratio, according to BlackRock, is 6.56 times, and the price to book ratio is 0.82. So some pretty impressive figures behind this. It's quite strong on the value metrics, although some of the BlackRock data is a bit iffy, but at least it's in the right direction. So the stats seem to offer better value than the FTSE 100, but does it matter where a company is located? Well, clearly you'll have different currency exposures depending on where the company is located. Then also you've got other countries that it trades with, such as China. But arguably, the country where a company is located is not the most important factor, with things like indebtedness and profitability metrics being far more important. And so I do quite like the idea of an Asia Pacific dividend ETF. So they say the meek shall inherit the earth, but maybe it's actually the value investor, providing that he's patient enough. When talking about rock solid dividends, it would be unfair not to mention JP Morgan Global Growth and Income. Although it will never be a dividend hero because it pays out dividends based on the net asset value of the investment trust, and this can vary throughout the economic cycle, it still has a very impressive price performance, and with a yield of 4%, it's likely to do well for your income into the future, and it's worthy of consideration. The kicker remains the same. Equity's unlimited potential for capital appreciation. Just think about that and let it sink in for a few seconds. So I saw this article from JP Morgan and it raised some interesting questions. So the first one is, how many assets do you really need? And JP Morgan say that 2 will do the job, 1 global equity fund and 1 broad bond fund in your own currency. And I partly agree with that. I would certainly say that you don't need to move into asset classes that you don't like or don't understand, you can still diversify with maybe just even 2 or maybe 3 asset classes. It then says, are there any superior asset classes left? So it means things like, so it's digital infrastructure, shipping contracts, all kind of things like that. And it claims that there aren't many because knowledge will pretty soon get new capital to flow into these sectors that do have initially high returns, and their returns will come back to more of a long-term average that you'd expect for that asset class. This week, Digital 9 Infrastructure announced that it was scrapping its dividend, and its share price, which had previously had a dismal performance, finally collapsed. So the rule here is that my hips don't lie, or my price don't lie. So if you do find an investment trust with a continually falling price, you're probably better off staying well away. And don't forget that the fees it charges are based on the net asset value, which is this higher purple line here, and not on the share price. So you end up getting stung by very high fees if the price does collapse. So the problem with property and infrastructure is that the underlying returns are average, so they use cheap debt to improve those returns. They then possibly pay out excessive dividends to entice investors, and then when interest rates rise, that puts pressure on the debt that's been taken on, and the dividends have to be cut. And also at the same time, the risk-free rate of return has gone up, and it seems pointless taking risks on some rather shonky assets when you can just invest in an overnight money market fund. So for a more esoteric investment trust, you have to ask yourself, do you really understand it? Does the investment trust have a track record so that you can see how it performs under stress, times of recession, high inflation, or high interest rates? You've also got to ask yourself, why do you think it will have an above average return? And also, what could possibly go wrong? And in a lot of cases, there's quite a few things that could go wrong. These sorts of investment trusts are best avoided. Do have a concern that dividends from investment trust dividend heroes won't increase in line with inflation. But fortunately, you could argue that retirement expenditure won't increase with inflation either, because as you get older, sometimes your desire to spend money on more luxury things like travel decreases. So my conclusion for a rock solid income portfolio would be that it would mainly consist of equity funds, that each fund would need to have 10 or more years dividend record. It might be dividend growth, or it might just be that it pays out a percentage of net asset value, and the feeling is that that net asset value is fairly stable or growing over time. I would look for the average yield to be over 4%. So you'd have some maybe slightly lower yield, but with dividend growth. And potentially, if the yield did exceed more than 4% in a year, you could also hold some back as cash, and then you've got money for the lean years. So I hope this video has given you lots of insights, and I recommend you watch this next video coming up.